let's not forget, Russia is the 8th largest global silver producer and is estimated to produce about 1,400 tons of silver in 2025. Now, with the Russian central bank and the military complex recently diverting local production to stockpile silver, liquidity providers assess that this additional global offtake is not factored into the current supply-demand silver price, which is already in a deficit. And it is so disruptive, it tips the global supply deficit to force other competitive buying from China, India, and also from consumers who are going directly to the mines to produce, to source supply. Now, while spot silver is not Basel III compliant, it's important to understand this. Yes, it's not Basel III compliant, but it is a deliverable foreign exchange cross against the dollar, pound, euro, etc. And as with silver, and because silver supply is getting priced outside the LBMA's control, the Loco London Global Silver FX Fix, benchmarking the global physical supply demand settlement price, will have to rise to meet this fresh demand. And that's further going to drain Loco London's supply, which is already at critical levels. Now, the silver fix actually benchmarks a direct producer to end user price. And so any discrepancies are simply being arbitraged. And liquidity providers report continued accumulation of underpriced LBMA CME silver is currently now in the BRICS crosshairs, as it have been for some time, but it's stepping up. And very, very, very short term, silver under $38 is unsustainable. Yeah, with the physical silver trade now largely bypassing Loco London, we looked at this last time, these same actors in silver futures are still exposed, well, not just silver futures, but also to unallocated spot silver, are still exposed to these Office of the Comptroller, OCC derivative bets, which are being targeted for delivery by the physical markets and have become increasingly difficult for the Fed to cover. And this is evident by way of declining open interest, or let's say the number of chips in play. Now, with the COMEX silver market paper settled liquidity, alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked, silver has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that the savvy buyers, the controllers, are in China, and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now, but it's coming. Now, also, so following on from our last episode, where we delved into the gold-back tokenization and financialization of really potentially trillions of real-world assets, and based purely on supply-demand gap filling, this leads to a fair value price of 8,000 gold, and that is conservative. And as we recently indicated, silver well into the 3 digits. Now, while this tokenization gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's gross underestimation of BRICS nations' ability to take full control of the gold and silver price setting mechanisms, and how, through the formalizing of the financial infrastructure to support a sufficiently liquid global settlement price, the CME LBMA will increasingly become price takers and not price makers. It's so important to understand this. It is a change of behavior. This is happening under our noses, and as we will see, it's central bank driven. China has actually accrued sufficient physical market liquidity to benchmark a self-arbitraging, fungible global sanction and tariff-proof gold price for T+0 settlement. And we looked at this kind of last time, and don't forget, there's some important things that a lot of people don't understand here. China's cross-border payment system, which really you've talked to when you look at Bloomberg and all it's really not mentioned. It already interconnects with almost 5,000 banking institutions, and that is growing on a day-to-day basis. Now, this CIPS settlement platform, the CIPS settlement platform, overtook SWIFT transactions back in April. We thought it was May. It was actually back in April. Now, what is really missed by Western media reporters is that the Chinese yuan and the Russian ruble trade on the Basel III NSFR compliant gold standard blockchain rails because they're fungible. Both currencies are one-to-one backed by physical gold. Now, you can either hold those currencies or exchange them at par for physical gold. I mean, that is what used to be, the US dollar used to be backed by physical gold. The yuan and the ruble are backed by physical gold. Now, you net this out. The ruble price of gold is consistently around $10 higher than the local London benchmark price. I've looked at it again today. It's every day it's around $10. And alongside the yuan price of gold is consistently around $5 higher than the intraday local London price. That's netted out. Now, prior to local London fixes becoming Basel III compliant in January 2023, it was not unusual to evidence, if you remember, we used to see $50, and in fact, as high as $100, but we used to regularly evidence $50 higher prices, yuan gold prices, than London, and how this regularly drove a massive arbitrage opportunity as underpriced Western exchange traded fund and COMEX gold and spot gold, unallocated spot gold, was drained to capitalize on these real world premiums. Therefore, due to its global fungibility, and this is the key, because gold is fungible globally, when the price of gold in yuan is higher than the LBMA fix, nations seeking to pay for or deliver commodities in exchange for their national currencies, they'll simply buy London spot and arbitrage the difference. This has created a backwash into the LBMA fixes, forcing really unwanted discipline upon it, because the unallocated gold in London, other than at the fixes, has up to a 20% haircut. Now, as we drew attention to during the BRICS summit, backed by central bank sovereign and fresh safe haven physical demand, China's expanding Shanghai vaulting network that's been established, it's being established in Singapore, in Hong Kong, Saudi, Russia, Brazil, Africa, Southeast Asia. It's global already, and they're already, this group, these vaults have already aggregated sufficient physical market liquidity to benchmark a global, physically determined supply-demand gold price to be locally delivered. Now, tokenizing BRICS collaborations into stablecoins and backed by real assets, along with a race to secure as much gold as possible to back the value of each nation's foreign exchange currencies, provides the BRICS nations and their counterparties with a very liquid 7-second settlement process, maximum 7-second settlement process. And bearing in mind that you've got vaults around the world where literally a T+0, because it's fungible, a T+0 delivery can be moving gold from one side of a vault to the other nation's holdings place. So while everyday BRICS pay transactions that people look at are not directly backed by a weight of gold, they're ultimately underpinned by a yuan gold standard. So sales of goods and services and commodities are valued against gold So that's how they're benchmarked, and then directly convertible into physical gold. This is what is going on. It's just not realized. Ultimately, with gold increasingly backing real world assets, the US administration, we said last time, they've got two choices. Either head into a losing battle against the global majority, which kind of is what they're attempting now with all of the BRICS nations under the crosshairs for tariffs and one thing and another. It's going to backfire. Then the only other choice they have left is to revalue gold to compete. So the four precious metals being benchmarked at the global facing FX fixes have now secured really sufficient physical market liquidity to force the LBMA CME cartel to become price takers. So, and guess who's setting the COMEX price right now? So as we've just highlighted, really, the Fed is once again facing buying back borrowed Bank of International Settlement gold leases into a 17-month series of physically determined higher prices. And the last tool in the toolbox, we're just pointing out, is blunted, and there's just not enough speculators left to lay paper gold liabilities onto to offset how much unallocated gold and silver is being alchemized by China and Russia right now, right under our noses. Well, that really just leaves one question. We global gold and silver buyers are no longer in the minority. We used to be. We're not in the minority anymore. So my question is, have you also joined the global majority movement who are as quickly as possible converting their rapidly depreciating debt-pat fiat currencies for physical gold and silver?
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.